Welcome back to the Candlestick Workshop, everybody. In this class, we are going to be focusing on just regular candlesticks. Now, before we even get into the candlestick part, we have to make sure you understand two terms known as bullish and bearish. When traders refer to a stock as bullish, they usually mean that the stock looks like it's going to go up or has increased in price. So when we refer to a bullish candle, it means that candle has either increased in price or it gives us the perception that it will increase in price. Next up, we have bearish, and bearish is the opposite of bullish. Bearish refers to a stock that looks like it's going to go down in price or has decreased in price. So when traders refer to a bearish candle, it means that the price is either decreased or gives the perception that it will decrease. So now that we know what bullish and bearish means, let's look into what makes a candlestick. So into looking at a candlestick, you will see that it's made up of 4 parts, but it has 2 main characteristics, the real body and the wicks. For this example, we're going to start off with the bullish candlestick. Now, the real body is represented by a square. It is made up of the open and close prices. Since it's a bullish candle, the open is at the bottom and the close at the top, meaning the price move up during the candle's formation. Then we have our wicks. The upper wick is made up between the close price and the high, while the lower wick is made up between the low and the open price. A bullish candle is usually shown by the green real body, just like you see here. Now, if this is confusing, don't worry. Let's show you an example of what I mean by all this. So as stated before, each candle represents a certain amount of time. Let's say this candle represents 4 hours of trading. At the beginning of the 4 hours, the price opened up at $1.10. It then reached a low of $1, but it bounced back to hit a high of $1.30, then came back down to close at a price of $1.20. This means that within the 4 hours, the price increased by 10 cents as it closed at $1.20, 10 cents up from the open. One thing to note is that the longer the real body is, the more bullish it becomes, as it shows there are more buyers than sellers and that the price was increasing dramatically. So now that I know what a bullish candle looks like, let's look at a bearish candlestick. And as you probably already guessed, a bearish candle is made up of the 2 same parts, the real body and the wicks. The only difference is where the open and close appear. On a bearish candle, the open is at the top and the close at the bottom, meaning the price decreased during the candle's formation. Then we have our wicks. The upper wick is made between the open and the high price, while the lower wick is made between the low and the open price. And a bearish candle is usually shown by a red real body, again, just like you see here. And like always, let's run through a quick examples. Let's say this candle represents 5 minutes of trading, and at that 5-minute open of this candle, it opened at $1. It then went to hit a high of $1.05 before dropping and hitting a low of 90 cents. Then it closed at 95 cents. This means within the candle's formation, the price decreased by 5 cents as the open was at $1, but the close was at 95 cents. Now, I hope you enjoyed this quick lesson in understanding candlesticks. In the next lesson, we're going to look how to trade with candlesticks and look at candlestick patterns as well. So if you're ready, let's hop into the next lesson.